everyone, welcome back to our channel. Now we have all heard about credit scores, that all-important number that can make or break our financial plans. But let's be honest, when it comes to credit scores, how many of you are really sure about what affects them and what doesn't? Are you someone who's always wondered if checking your credits hurts your scores or if income actually matters? Well, today we are going to clear these questions once and for all. Before we dive into, though, drop and comment below and let me know what's the most confusing thing you've ever heard about credit scores. I'm curious to see what myths you've encountered. Let's get started. First, let's talk about why credit scores are important. Your credit score is a key factor in determining your ability to secure financial products like loans, mortgages, or credit cards, and it also affects the interest rate you will be offered. A good credit score can mean the difference between getting approved or rejected, or even saving thousands of dollars on interest rates. But despite this, there are still a lot of myths that people believe about credit scores. Let's get started by clearing up some of the most common ones. Checking your credit report will hurt your credit score. This is one of the most widely believed myths. But the truth is quite opposite. When you check your credit report, it's considered a soft inquiry. This means that it does not impact your score at all. In fact, regularly checking your credit report is a smart way to monitor your financial health, catch any mistakes, and prevent identity theft. So feel free to check your score as often as you like. It's a responsible habit that can help you stay on top of your financial game. Your income affects your credit score. This one can be confusing because your income plays a big role in your overall financial health. However, your income is not a part of the credit score calculation. Credit scores are based on factors like your payment history, the amount of debt you have, the length of your credit history, and the types of credit you use. Your income, while important for budgeting and managing your bills, does not directly impact your credit score. What matters most is your ability to manage your credit responsibly and make payments on time. Applying for multiple credit accounts help improve your credit score. This is a myth that can be really tempting to believe, but it's actually harmful to your credit score. Each time you apply for a new credit account, the lender conducts a hard inquiry on your credit report. While a single inquiry might not have a major impact, too many hard inquiries in a short period can lower your score and make it appear like you're struggling financially. Additionally, lenders might see you as a high risk if you're applying for credit frequently. So instead of applying for multiple accounts, focus on maintaining a good mix of credit and making payments on time. This is another common misconception, but it's not true. Closing older accounts can harm your credit score. Older accounts show a long credit history, which can be very beneficial for your score. The longer your credit history, the better it looks to potential lenders. Closing old accounts reduces the overall length of your credit history and may increase your credit utilization ratio, which could negatively impact your score. So if you have an old account in good standing, it's generally best to leave it open. You can't get a loan with a low credit score. While it's true that a low credit score can make it harder to secure a loan, it does not mean it's impossible. Lenders may still approve your loan, but you're likely to face higher interest rates or less favorable terms. In some cases, you may be able to get a loan with a co-signer or by providing additional collateral. So if you find yourself with a low credit score, do not give up hope just yet. Instead, take steps to improve your score over time or explore alternative lending options that might be available to you. Let's quickly recap what we have learned. Checking your credit score does not hurt your score. Your income does not affect your credit score. Applying for multiple credit accounts can lower your score. Closing old accounts can hurt your score. You can get a loan with a low credit score but expect higher interest rates. Now that we have debunked these credit score myths, I'd love to hear from you. Which of these myths surprised you the most? Or maybe you have a credit score myth that we didn't cover today. Drop it in the comments and let's keep the conversation going. If you found this video helpful, hit that like button and consider subscribing. We've got more financial tips coming your way. And remember, your credit score is in your hands. So take control and start making smarter financial decisions today. Thank you for watching and I'll see you in the next video.